Good morning. It is 8:37 a.m. Pacific Daylight Time. It is the 8th day of April 2025. This is episode 1070 of Bitcoin, and DOJ, the Department of Justice, ladies and gentlemen, has apparently shuttered the crypto crime fighting division. We're going to get into that one. We're also going to talk about Dubai and possibly, yes, you guessed it, real estate on the blockchain. For God's sakes, please help us. Please let it stop. Make it stop. 10-year yields. I told you about it. Apparently, it's very important also to James Van Straten and Omkar Godbol. They're going to be writing their thoughts about the all-important 10-year yield. Like I said, man, I told you about this yesterday. I was first. I knew it was going to be important, and yes, I have indeed been correct because they wrote a whole story about it. And then, of course, the Trump tariffs, but this time through the eyes of a guy named Ray Dalio. And then Bernstein analysts kind of impressed with the resilience of Bitcoin, and they've got some news on that one. I'm going to bring back up later in the show how important it is for you to run a node. You need to run a node. It's not that hard. Honestly, it really isn't. And no, you're not going to get in trouble for it like the guys over at Samurai. Lola Leitz has a piece about whether or not Trump is going to do something about the guys from Samurai. I mean, will he free them? One can only hope. One can only hope. And then there's been a lot of talk about this BIP, this Bitcoin improvement proposal about quantum resistance. Yeah, we finally got somebody, a guy named Alex Larry is going to write up a piece on that one. And then the FTX debacle continues. It just continues. And then we've got a small update from No Bullshit Bitcoin. But first, let's go all the way back to the DOJ shuttering the crypto crime fighting division. And it calls the unit a reckless strategy from Biden's administration. Well, according to Fortune magazine anyway. Naga Avin Namayo is writing this one for theblock.co. Todd Blanche, U.S. Deputy Attorney General and Trump's defense lawyer in 2024, issued a memo directing the immediate shutdown of the Department of Justice's crypto litigation division as authorities adopt a friendlier roadmap for digital asset oversight, according to Fortune on Tuesday. The 4-page notice issued on Monday stressed that crypto regulation was outside of the Department of Justice remit. Blanche wrote that the previous government under former President Joe Biden leveraged the Justice Department in a reckless strategy to police the blockchain industry via enforcement action. The deputy AG told staffers to instead prioritize investigating individual bad actors and criminals targeting crypto investors. Biden's administration formed NCET in the year 2021 as a collaborative legal strike team comprised of United States attorneys for the DOJ Cybercrime and Money Laundering Office. NCET, or NCET, department worked on several landmark cases like Crypto Mixer Tornado Cash and the $100 million Mango Markets exploit executed by Avraham Eisenberg. Eisenberg was convicted on fraud charges last year while the U.S. Treasury lifted sanctions on Tornado Cash following the court ruling. Blanche's directive comes as federal agencies change course on crypto regulation in February. The Securities and Exchange Commission, under acting chair Mark Uyeda, announced plans to scale down the watchdog's Special Crypto Enforcement Unit. Jorge Tenerio, the SEC's top digital litigator, was reassigned to a department tasked with maintaining computer systems as part of the overhaul. Wow, I got bumped down to IT. Shit, bro. The move signaled a new tune within agencies as Trump's return as the first pro-crypto president promised more flexible oversight. During his campaign trail, the Republican leader vowed to position the United States as a global crypto capital, and in March, Trump signed the executive order to establish a Bitcoin reserve, which I ain't seen jack shit done of since. Yeah, honestly, just, I hate to say it this way, shit or get off the pot with that thing, okay? Let's move on over to Dubai. Ezra Reguera from Cointelegraph says the Dubai government agencies are going to link real estate registry with property tokenization. It sounds like houses and buildings on the blockchain to me. Let's find out. Dubai's real estate and crypto regulatory authorities have signed a new agreement aimed at expanding digital asset adoption in the real estate sector. On April the 6th, the Dubai Land Department announced an agreement with the Virtual Assets Regulatory Authority. According to the announcement, the agreement will link Dubai's real estate registry with property tokenization through a governance system. The agreement aims to improve digital infrastructure and attract global investment by enhancing market liquidity and property management efficiency. It also aims to support Dubai's broader economic strategy, which includes the goal of doubling the city's gross domestic product over the next decade. The new development follows the DLD, the Department of Land Development, their recent project pilot to convert real estate assets into blockchain-based digital tokens. On March the 20th, DLD announced the pilot phase of its real estate tokenization project. The launch made DLD the very first real estate registration entity in the United Arab Emirates to tokenize property title deeds. The DLD expects the initiative to drive growth in real estate investment, aiming to reach a value of over $16 billion by 2033. And Scott Teal, the co-founder and CEO of real-world asset tokenization platform TokenVest, told Cointelegraph that the new development shows a clear message from the UAE government. Quote, in just 3 weeks, Dubai has gone from pilot launch to strategic execution, and the message is loud and clear. The future of real estate investment is on chain. Oh, God, please make it stop. This is, in fact, buildings on the blockchain. And I'm just going to pause here just to remind everybody and their dog twice, if it is a real world asset, the deed, like let's say you've got a house, you got a property deed for the house, it's on file at the courthouse and, you know, at your county seat and whatever county you live in, and we're talking about the United States here. And it's a good example because deeds to property are all over the place. They're in all kinds of countries. But in the United States, your deed is on file, right? That's kind of a paper token, right? But it's not going, that deed doesn't give you shit. If men with guns want to take your house, that deed doesn't do you very much good. Now, if it's men with guns that are not sanctioned by the government, yeah, that deed is definitely going to help. But if those men with guns are government entities or from government agencies, that deed doesn't do you shit. And neither is this. This is a waste of time. But let's continue. Teal said that the two agencies are working hand in hand to create a smarter model that opens Dubai real estate market to a global pool of investors. This isn't just another memorandum of understanding. It's a playbook for real estate 2.0. Oh, man. The executive urged investors across the globe to observe what the UAE is doing in terms of tokenization. Teal said, this is what the future of real estate looks like. No, it does not. No, it doesn't. This is the same tired ass crap. Remember bananas on the blockchain? We're going to be able to prove that the bananas came from this particular, region in, let's say, Central America. No, it doesn't prove anything. It's a real bananas and houses and buildings and cars. If it exists in meat space, tokenizing it makes no sense. It's a fool's game, and all it is here to do is to hype up the other aspects of, quote, cryptocurrency that gets people to give other people their actual money. And please, for the love of God, stop doing that. The 10-year yield has risen above 4% again. I talked about it yesterday. I think right now it's at 4.22%. And when I was talking to you yesterday, it was somewhere around 4.18. So from yesterday to today, the yield on the 10-year has gone up again. Now, the all-important U.S. 10-year yield is moving in the wrong direction for Trump. And this is James Van Stratton and Omkar Godboll writing it for CoinDesk.com. Monday's trading session will go down as one of the most volatile since the COVID crash in March of 2020. Global markets caught in the crossfire as the United States and China face off over tariffs, and neither superpower shows any impulse to back down. As equity markets teetered, the volatility spilled into every single asset class. Bitcoin swung as much as 10% intraday. The real focus, however, is on the United States 10-year Treasury yield. That is the so-called risk-free interest rate, which the Trump administration said it wants to lower as it looks to refinance trillions of dollars of national debt. The yield dropped to 3.9%, all the way from 4.8% late last week, after Trump bolstered trade tensions with sweeping import tariffs, boosting demand for the Treasury notes. Bond prices typically rise, sending yields lower when Wall Street turns risk-averse. Unusually, as the risk aversion increased on Monday, yields turned higher, jumping to 4.22%. This spike was not confined to the United States. The UK experienced its sharpest rate jump since the Liz Truss-era pension crisis in October of 2022, and yields rose globally, signaling growing instability and diminishing confidence in sovereign debt and currencies. You mean, is it possible people are starting to get a freaking clue that when you are buying print or a debt that can just be printed out of thin air, that maybe it's not a risk-free asset? Is it possible that maybe other people are starting to look at U.S. Treasuries and UK gilts and whatever the hell you want to call this shit out of Germany? Is it possible that they're looking at that as toxic debt? Well, I've been saying that for 6 months, but Ole S. Hansen, the head of commodity strategy at Saxo Bank, pointed to the scale of the move in long-dated treasuries as a sign of something deeper potentially unfolding. Quote, U.S. Treasuries suffered a massive sell-off yesterday, with long yields rising the most since the turbulence during the pandemic outbreak, a possible sign of large holders of treasuries, such as foreign holders, selling and repatriating their assets. The 30-year U.S. Treasury benchmark rose from lows near 4.3% to as high as 4.65 yesterday, while the 10-year benchmark lifted back to 4.17% from a low near 3.85 the prior day. While Hansen pointed fingers at foreign selling, especially China, which is said to have offloaded $50 billion in treasuries, Jim Bianco, president of Bianco Research, challenged that narrative. No, foreigners were not selling treasuries to punish the U.S., he wrote, pointing instead to a sharp rally in the dollar index, which climbed 2.2% in just 3 days. Quote, if China or other foreigners were selling treasuries, they would have to convert those dollars to a foreign currency. Otherwise, selling treasuries and leaving money in dollars in a U.S. bank is pointless. If they sold enough treasuries to swing yields, the subsequent selling of dollars would have driven down the dollar. Instead, however, it rallied more than usual. Quote, this suggests that foreign money was moving into the United States, not away from it. The selling was more domestic and more concerned about inflation, end quote. Despite these conflicting views, unconfirmed reports about China's sale continues to circulate. As of January of 2025, China still held approximately $761 billion of U.S. government debt, the largest owner after the nation of Japan. The narrative that the 10-year and 30-year yields surged on Chinese is unconvincing because most of the official Chinese investment in dollar-denominated assets are not any longer duration instruments, but agency bonds, shorter-term bills, and bank deposits. There is a perception that China can gain leverage in the trade war through its holding of U.S. Treasury notes. Not necessarily true. As the economist and author of The Great Rebalancing, trade, conflict, and the perilous road ahead for the world economy, Michael Pettis has long argued China's holdings of U.S. Treasury bonds are directly linked to its current account surplus, and it cannot weaponize these holdings against the United States. It's no surprise that China has been lightening up its Treasury investments since 2013, with its current account surplus peaking during the 2008 crash. So there is clearly some conflicting ideologies about which way and why. Well, we know which way the yields are going. No matter what anybody does, they cannot get these yields down. And that's what Trump has been wanting to do. He wants the yields on this 10-year bond down so that he can go to Jerome Powell and say, the Fed's going to have to match. You're going to have to lower your rates. And it's not working. It's just not working. And I'm sure that's frustrating to all these people. But as far as weaponizing U.S. debt against the United States by China, who knows? I honestly expect them to actually kind of do that. But what breaks free? See, that's the whole thing. The world is swimming, not just in their own debt, but in our debt. Everybody holds U.S. Treasuries because we, somehow or another, were so successful at making the United States dollar the world's reserve currency that the debt instrumentation behind it came along for the ride. And now everybody's holding this paper going, but they're just printing more. See, it's just like us. The rest of the world is just like us. They print dollars, and we say, you got to stop printing money because this is ridiculous. On the outside, though, they just print debt, and it's just as bad. It's probably worse. And when you see the collapse of the banks a couple of years ago, there was 3 or 4 of them that went down all together over a weekend, and it was because they were holding a shit ton of treasuries. Because after COVID, some rule changes occurred where banks had to have treasuries on their books. They were sort of forced to buy this particular instrumentation. And then the face value of the bond started to collapse. And all of a sudden, they didn't have the backing to be able to say that they've got enough to back the deposits in the bank. This is a terrible situation, and those 4 banks basically just poof went up in smoke. Except for one of them didn't need to, but it was so bad. I guess the debacle was so, I don't know, so out of control that I believe the name of the bank was Silvergate, and they had everything that they needed to make every single depositor whole, and yet the FDIC took over, like they took over all the other banks. And they just sold it all. It's just the debt instrumentation of the United States is not what I think many people think it is. I think it's a lot more toxic than many people think it is. It took me forever in this space to figure out what the hell a bond really was. And honestly, I'm still learning exactly what a treasury bond actually is, why it exists, what is it used for, and how is it used in manners of control. And that is a huge nut to crack. And dude, that's just treasury bonds. Think of all the other bullshit derivative crap. The instrumentation of debt in this world is out of control. But you know who's not out of control? SoapMiner. SoapMiner is in control. He's in the Circle P and he's selling you soap. You want to get clean, ladies and gentlemen? You got to get SoapMiner's all beef tallow soap. Depending on which one of the 5 flavors you choose, there's cedarwood, there's peppermint, there's lavender, there's pine tar, and then there's just straight, unscented, unperfumed, rough cut tallow soap. It has all of 3 ingredients: 100% beef tallow, lye, and distilled water. So my wife, a couple of days ago, said to me, I used one of those bars of soap. I go, which one? She goes, I just used the rough cut tallow soap on my hands. I was just washing my hands. And I go, well, what'd you think? And she's like, she's in love with this soap. It makes her hands feel soft. It gets clean. It rinses clean. And you can buy any one of the 5 bars of soap from SoapMiner.com. That's SoapMiner.com, SOAP miner.com. Go over there. Order his soap because he sells it for Bitcoin. If you don't sell it for Bitcoin, you are not in the Circle P. When you leave a note, he's got a little space on his order form at SoapMiner.com where you can put in whatever you want to put in. Say, I heard it here on the Circle P, on the Bitcoin and podcast, and then maybe SoapMiner will cut me a few Satoshis for making him a sale. Other people on Nostr are starting to talk about SoapMiner soap. I am very happy that I decided a long time ago to put SoapMiner in the Circle P. No, I did not ask his permission. I will only ever ask forgiveness. Again, that's SoapMiner.com. Go get your 5-ounce bars of soap. Do it now. Do it now. Make sure you tell him you heard it at the Circle P. And he doesn't tariff either, because tariffs are just the tip of the iceberg, according to billionaire investor Ray Dalio, and Vince Diaquino is writing this one for Decrypt. Billionaire investor Ray Dalio suggests that the past week's market meltdown triggered by President Trump's sweeping tariff policy reveals more than just short-term volatility and a flight to safety. Dalio, who founded Bridgewater, the world's it's the world's largest hedge fund by discretionary assets under management, whatever the hell that means, wrote Monday that the world is witnessing a, quote, once-in-a-lifetime chaos that signals a breakdown of the global order. That's a pretty hefty charge there, Ray. Late Monday evening, Trump threatened to raise the tariffs on Chinese goods by an additional 50%. China's Ministry of Commerce responded, claiming that the country will resolutely take countermeasures to protect its rights and interests. Quote, while these tariff announcements are very important developments, and we all know that President Trump caused them, most people are losing sight of the underlying circumstances that got him elected president and brought these tariffs about, Dalio wrote. He argues that tariffs are merely symptoms of 5 underlying forces reshaping the global order. 1, rapidly mounting debt. Can you say treasury bonds? Domestic policies. 3, a shift in how geopolitical power is wielded. And 4, acts of natures. And 5, the impact of technological innovation such as AI on the world economy. Debt has become unsustainable because of the large imbalance between debtor-borrowers who owe too much debt and lender-creditors who already hold too much, Dalio argued, citing the relationship between China and the United States. While nascent crypto markets have increasingly moved in lockstep with U.S. equities, showing sensitivity to macroeconomic indicators such as inflation readings and central banking decisions on rate cuts. Bitcoin's dive below $75,000 level less than a day ago, coupled with the broader market, crypto market's rapid 7% contraction over the past weekend since, quote, Liberation Day, point to what Dalio describes as a classic breakdown of the major monetary, political, and geopolitical orders rather than simply a reaction to just trade policy. Dalio argues that the interconnectedness of trade and capital flows means that when the unsustainable debt conditions and breakdown of international order materialize into concrete policy actions, the resulting flight to safety affects all risk assets simultaneously. Meanwhile, observers note that the rise in U.S. Treasury yields signals diminishing demand for government debt instrumentation and opens up inflationary expectations. Still, some divergence may be emerging. Bitcoin has gained relative strength against the Magnificent Seven tech stocks, suggesting that, in theory, the asset can temporarily decouple from traditional risk assets. Matthew Siegel, head of digital assets research at Van Eck, previously told Decrypt that while 10-year Treasury yields surged on Monday, Bitcoin's reaction was notably subdued, suggesting a potential decoupling from old macro sensitivities. And indeed, we saw that. At the end of last week, we saw that basically a Black Friday event. Major indices just tanked all over the place. Everything was down. Everything was red except for Bitcoin. It took until Sunday It took until Sunday afternoon before the actual price of Bitcoin started to follow suit and tank. And I believe it was Rodolfo Novak out of CoinKite that put a note on Nostr that with a little laughing face that said recoupling commencing or something like that. But still, that 48-hour, 72-hour period in which we were all dancing on equity markets' graves because, hey, look at Bitcoin. It didn't do anywhere close to as bad as you guys did. That represents a possibility in the future for other investors. Think about it. And I don't want to use I hate using the analogy of blowing up a bubble, but have you ever blown up a balloon? Like in the old days when balloons actually, were kind of hard to blow up and you had to like kind of force air into it with your mouth and you had to blow it a couple of times to kind of, and then you'd have to take the balloon back out and stretch it to kind of relax the rubber in the walls. And then it became easier to blow, but still the first few puffs of getting air into that balloon were still really difficult. But once it hits a certain point, it becomes way easier for air to flow into that balloon. Again, I really hate using this term because bubbles and balloons and whatever, but in either event, you get what I'm saying. And that's sort of what I'm seeing. I'm seeing like over a period of time, it's like the pressure release valve that Bitcoin can be is being tested. And air is being pumped into that thing every single time we get these shocks to the system, but then it flows back out. But at one point or another, I expect the rubber on that balloon to relax enough. Enough air will be pumped into it hard enough at one point or another that it will become a very relaxed environment. And Bitcoin will start soaking up the massive amount of whatever it is. Money, debt, derivatives, everything ends up being a situation where maybe we can just put it in, maybe we can cash out of this and just put the money into Bitcoin. And I think it's getting easier for that to happen. But again, as always, we will have to see. But before we run numbers, let's do this one from The Block and Adam James. Bernstein analysts argue that Bitcoin's resilience has been nothing but impressive through the tariff troubles. Now, these people are going to echo what I'm just kind of talking about, but they'll probably use a different analogy. Though U.S. President Donald Trump's tariffs have wreaked havoc in both crypto and traditional markets in recent days and weeks, Bitcoin's resilience has been nothing but impressive, according to Bernstein analysts. Citing historical data, the analyst noted that the foremost cryptocurrency used to see drawdowns of between 50% and 70% in previous periods of crisis, such as COVID-induced market panic, rate shocks, etc. Quote, the current price action, which is down 26%, suggests demand for Bitcoin from more resilient capital, they wrote in a note sent to the block on Tuesday. The analysts argue that the Bitcoin price is acting as a leading indicator of where risk is leaning does not detract from its long-term outperformance as a store of value in the digital realm. Quote, in our view, Bitcoin on a time scale is probabilistic gold, they wrote, adding that, quote, it trades as a higher volatility and more liquid version of gold. So there you go. Even the Bernstein analysts are starting to see a trend. And that's what I'm talking about when I say it's easier and easier to get money into. It's easier and easier for investors to look at Bitcoin as a potential, at least a holding pattern. Instead of just going back into dollars, maybe, just maybe, we start stacking some of this, whatever we got out here in equity markets and financial legacy stuff, and we start shoving into Bitcoin. And as that balloon's walls get a little bit weaker, a little bit more, I should say more relaxed, not exactly weak. You can shove more and more stuff in there faster and faster until all of a sudden you get, God, I hate doing it, inflated. You can easily inflate this thing. And I've always kind of looked at Bitcoin as the potential final resting place, as the escape hatch for all of the bullshit that we've done to ourselves in this modern society. Let's run the numbers. Futures and commodities, we've got some, I guess, a little bit of relaxation in the markets today. Oil is up 1.5%, up to $61.59 for West Texas Intermediate. Brent North Sea is up only 2/3 of a point to 64.64. Natural gas, 2.19% to the downside, and gasoline is up 0.75% to $2.03 per gallon. Gold hitting back above 3,000 after a 1.5% gain. We're looking at $3,017.60. Silver is up 1.35%. Platinum is up a point. Copper is down 0.12%. Palladium is up 0.5%. The biggest winner in ag today looks to be rough rice, 2% to the upside. Biggest loser is chocolate, 2.7% to the downside. Live cattle, meanwhile, crawling sideways slightly in the red. Lean hogs, 0.64% to the upside. Feeder cattle up 1/4. Now, wow, we're seeing some really decent recovery in legacy markets. The Dow is up 2.5 points, back to 39,154. S&P is up 2.5%. NASDAQ is up 2.8. Yeah, wow, 2.8%. S&P Mini is up 2.11%. Now, $78,370 for the price of Bitcoin gives us a measly, pathetic, wimpy-ass $1.5 trillion of market cap. You can only get 25.9 ounces of shiny metal rocks with your one Bitcoin, of which there are 19,848,266.53 of. And average fees per block are slightly higher, up to 0.05 Bitcoin taken in fees on a per block basis. And there looks to be 7 blocks. High priority transactions are going for 4 Satoshis per VByte. Low priority is going to get you in at 3. I need to pause here and make a couple of statements about this nonsense that I keep seeing. And I've been seeing it since I've been in Bitcoin, which is 2015. Okay? It's this notion that unless there are enough full blocks, that Bitcoin's going to die. And that translates into nobody's using Bitcoin. Okay, I've heard this 27 times, maybe 30, that there's not enough transactions. It's just going to die. Well, contrast that with all the times that Bitcoin was also going to die because there was too many transactions. The 67 times that Bitcoin was going to die because the mempools were full and there was too many transactions and fee rates were high and blah, blah, blah. Again, people stop. Those blocks are going to get mined whether there's a transaction in them or not. And second of all, the gas station analogy. I love analogies. Have you ever driven by a gas station and see not one person pumping gas? Did you ever once think to yourself that that gas station is going to die because when you happen to drive by, nobody was pumping gas, and the entire reason for the existence of a gas station is for people to buy gas, and when you drive by it and nobody's buying gas, did you actually stop and go, wow, I wonder when they're going to take a bulldozer to that pathetic ass gas station because clearly nobody wants any gas. It's a pathetic argument, and please don't buy into it. When you hear that crap, just, I don't know, continue your doom scrolling to something else. Because you know what? Who doesn't give a shit? The miners, dude. We hit what was it? Not exahash, a zettahash. Like over the last few days, we are still at 913.7 exahashes per second. That is a massive amount of compute power. There's no miner capitulation. None. These guys were mining at 700 exahashes per second when we saw prices in the $60,000 range. Now we're at 78,442. and we've got 900 exahash as a hash rate. The miners are seeing something that the rest of these people squealing about not enough transactions, they see something different. Why? And think about what they have. They have a world of infrastructure that they have to buy, maintain, provide power to, go out, get power contracts, go do all the things, reach for stuff. And yet they're not on Nostr or Twitter bitching about the fact that there's not enough transactions to make Bitcoin viable. You need to stop. I need to see everybody stop doing this, or we're going to end up with a Sunday, Bloody Sunday, which was yesterday's episode of Bitcoin. And I got Anonymous with 1,000 sats says, great episode. Chill Now One with 555 sats says, it's all gone, bitches. Timelines drown in flaky markets. Return to where it all started. Tired of the fake news lies? Learn how the orders were shaped. Irish fighter meme coin. Rainbow end popped empty. Derivatives of derivatives scam your coins away. He was searching for the truth, never asked to be the answer. Your mind is the interface. Your will is the command. The strongest move is silence. Encrypted. Unseen. Unstoppable. Nice. Psyduck with 578 says, Psyduck. Pies with 100 says, thank you, sir. No, thank you. And that is the weather report. Welcome to part 2 of the news that you can use. Running a node is the only way to know that you have Bitcoin, says Lightning Network co-inventor. This is out of atlas21.com on April 5th, during a talk at the MIT Bitcoin Expo 2025, Taj Drija, co-inventor of the Lightning Network, addressed several concerns regarding the Bitcoin protocol, particularly highlighting the disparity between the asset's market capitalization and the low actual on-chain usage. Oh, here we get to go. Yay. Drija stated, quote, Bitcoin has a market cap of trillions of dollars. But are people actually using it? Or are they using it the right way? End quote. Throughout his presentation, the Lightning Network co-inventor reflected on the current state of the network, pointing out that transaction volumes are low, and expressing concern over the lack of a competitive fee market, which is essential for the long-term security of the protocol. Drija also declared, quote, Bitcoin has value precisely because it works even when it's illegal. If it only existed with government approval, it would be pointless, end quote. However, many companies building on Bitcoin seem to overlook this, focusing instead on regulatory compliance, Drija observed, highlighting the contrast between the ideals of open source development and the corporate interests surrounding the industry. The key concept that emerged from Drija's talk is the principle, not your keys, not your coins. Drija made it clear that, in his view, Bitcoin held on exchanges or through ETFs, as well as nodes run via cloud services, do not constitute actual ownership of the asset. He also warned that scenarios similar to Executive Order 6102 could happen again, potentially leading to the confiscation of Bitcoin held with third parties. He stressed that there is nothing in Bitcoin itself that would prevent the issuance of an order similar to Executive Order 6102. In his opinion, if a government were to demand users Bitcoin from exchanges, the exchanges would hand them over without resistance. For Drija, Bitcoin's main advantages over gold lie in its easier self-custody and more discreet handling. Quote, running a node is the only way to know that you have Bitcoin. If you're not running a node, you're trusting someone else to do it for you. The Lightning Network co-inventor concluded by mentioning U-Tree-XO, a project aimed at making it easier for anyone to run a Bitcoin node. U-Tree-XO's goal is to reduce the amount of data needed, speeding up the initial block download i.e. the process of initial synchronization with the network. And honestly, ladies and gentlemen, it does not take all that much to run a node. It also doesn't take all that much to just walk away for 3 days during the IDB, or the initial block, or initial IBD, the initial block download. I've had to do it twice. It doesn't hurt. I don't get it. I mean, the only thing that I get is like, well, why would I want to run a node? It costs like a couple of $100 to set one up with enough memory to, get you to last for like a couple of years. I get that part. But the having to wait for the initial block download is, again, is kind of juvenile. But I'm not saying anything bad about U-Tree-XO. I think this is good. And I think that the ability to spin up a node and be able to, within, say, 30 minutes, maybe even 15, have enough of the initial block download that you can be confident that you've got at least 1,000 blocks. And the way, I won't get into the way Bitcoin works, because I'm hoping that most of you kind of know that the block before, like the last block mined, its hash depends on the hashes of the blocks before, plus all of the transactions, the hashes of all the separate transactions, along with the block hash before, because it's like a chain of hashes. And it's not very likely that if you've got 1,000 blocks in your node, that somebody's going to be able to break that. So I think that you'd be able to make, go ahead and say, this is my Bitcoin. I've got my cold card reading on Spectre wallet that's running on my node, and I've got all the gear. I've got the Electrum stuff set up. I've got my own Bitcoin node. You're completely self-sovereign. With 1,000 blocks, I think you're safe. And then that way, in the background, the entirety of the blockchain just continues to roll and roll and roll. Now, I think U-Tree-XO actually wants to take that down to the point where you're not even carrying the entire blockchain. I kind of advise against that, especially considering that in the future, the rate of storage and the cost of that memory storage is going to decrease at a far faster rate than the amount of blocks are going to, the amount of block size, or the amount of blocks are going to cause a memory size where you need a whole bunch of memory really quick. I think it's going to be inverse. It's going to be cheaper and cheaper and cheaper to hold the entirety of the blockchain for Bitcoin. And I think people should actually endeavor to do that. But I think if you can spin up a node and start learning how to use it, and it's not all that difficult, within 15 minutes to 30 minutes, I think that would be better. But I would hope that the entirety of the blockchain in the background continues to load, but in a way where you don't have to wait for it all before you can start using your node. Now, on to pro-crypto, anti-privacy. Will Trump free samurai? Lola Leets asks this question, Bitcoin Magazine. Last month, the Treasury lifted sanctions on Tornado Cash. In response, many rekindled their calls for the Trump administration to drop the charges against Kiani Rodriguez and William Lonergan Hill, the developers of Samurai Wallet, who are currently being prosecuted in the Southern District of New York. What many appear to have missed is that the Treasury's sanctions reversal for Tornado Cash also revealed the Treasury's stance on privacy services, and it is not looking good. Tornado Cash's removal from the OFAC SDN list followed a lawsuit by Tornado Cash users in a Texas district court case that has become known as the Van Loon versus U.S. Department of the Treasury, in which it was argued that the sanctioning of the software was unlawful and violated the right to free speech. The lawsuit went to appeal in the Fifth Circuit, where 3 judges ruled that sanctioning a software like Tornado Cash was indeed unlawful, as OFAC's SDN list was reversed for businesses, foreign nationals, and property of which Tornado Cash is neither. The Fifth Circuit, in turn, directed the Texas District Court to grant the plaintiff's motion for a partial summary judgment, which would constitute a binding court order that software like Tornado Cash cannot be sanctioned by the U.S. government under current sanction laws. Now the Treasury is fighting back in attempts to avert the judgment that would strip the agency of its powers to sanction immutable privacy software by arguing that a judgment is not needed because Tornado Cash has been removed from the OFAC list. But without the judgment, the agency could continue to sanction software that works just like Tornado Cash and even re-sanction Tornado Cash itself. The sanctions reversal on Tornado Cash has little to do with the prosecution of Samurai Wallet developers, as neither are charged with sanctions evasion. But the criminal prosecution of Tornado Cash developer Roman Storm is extremely important to their case, as it may set precedent for the prosecution of Rodriguez and Hill, who have been charged with conspiracy to operate an unlicensed money transmitter and conspiracy to commit money laundering. Both Tornado Cash and Samurai Wallet are purely non-custodial software projects which have long been understood to be exempt from falling under anti-money laundering frameworks usually applied to banks. If Storm is found guilty in July, the government would have a much easier time to successfully prosecute the two Bitcoin developers as well. While many were hopeful that the new administration would put an end to the former administration's witch hunt on cryptocurrency developers, it seems that Trump's Treasury is just as unfavorable to the department or to the development of privacy code. As CoinCenter pointed out at the end of last year, a pro-crypto administration does not necessarily equal a pro-privacy and pro-financial freedom administration. It seems that we are now witnessing what this means. While lawsuits are being dropped against crypto casinos like Coinbase and Uniswap, privacy software developers like Rodriguez and Hill continue to face threats of decades in jail. The Treasury appears to reason these prosecutions with their hardline stance against terrorist financing and cybercrime, as the agency wrote in the announcement of Tornado Cash's sanctions reversal. Quote, Treasury remains committed to using our authorities to expose and disrupt the ability of malicious cyber actors to profit from their criminal activities through the exploitation of digital assets and the digital asset ecosystem. In what appears to be a first, the Treasury also issued a warning for users of privacy services, stating that, quote, U.S. persons should exercise caution before engaging in transactions that present such risks. In an email addressing the reversal of sanctions against Tornado Cash, blockchain surveillance firm Chainalysis appears to echo the Treasury's sentiment, writing that, quote, organizations with exposure to mixing addresses should seek legal counsel on their responses and obligations to OFAC, end quote. And I expected nothing else other than Chainalysis to get on their knees and service their masters. That place is, I won't get into it. They've been a pain in everybody's ass for years now. The messaging does seem clear, however. While it is not officially illegal to use or deal with mixing services, the Treasury appears to attempt to keep all options open to pursue charges against persons involved with privacy services in the future. As I have argued in several Bitcoin Magazine print articles, this stance should not be a surprise and is rather an immediate consequence of integrating digital assets into U.S. regulatory frameworks. The more important Bitcoin becomes for the government, the more important it will be to root out any conduct deemed illicit or criminal. Treasury Secretary Scott Bessent has now argued as much in Tornado Cash's sanctions reversal, stating that, quote, securing the digital asset industry from abuse by, you guessed it, North Korea and other illicit actors is essential to establishing U.S. leadership and ensuring that the American people benefit from financial innovation and inclusion, end quote. While North Korea allegedly relies on cryptocurrency financing for its operations, the overall share of illicit funds within the cryptocurrency space is minimal, placed at a mere 0.14% of all on-chain transactions by Chainalysis itself. At the same time, the reasons for people to use privacy services are numerous. As every transaction is visible on-chain, privacy services help people keep their transaction histories and net worth private, which in turn protects their physical security. As Jameson Lopp regularly highlights in his Physical Bitcoin Attacks repository, having information about your Bitcoin public may result in violent home invasions, kidnappings, and in some cases even murder. The government's continued crackdown on privacy services does not seem proportionate to eliminating 0.14% of illicit actors, but it seems that the Trump administration is in no hurry to do the right thing to protect Americans and hashtag Free Samurai. So there's Lola Leet's take on what's going on, and I can't disagree. And the fact is that this shit spreads because we keep thinking, oh, well, it's privacy in crypto, right? It's privacy in this particular space. No, it's like anything. Even Tor developers could potentially have a problem. Anybody who is involved in software that somehow or another protects your privacy as a citizen of the world, much less your particular government and region, they're all at risk because of this crap. That's why it's important that we need to free samurai. And it's also important to understand that I'm about to read this from Alex Larry out of Bitcoin News, and there may very well be a couple of spots where I just call straight up bullshit or possibly start laughing my ass off. So just be prepared, because dormant coins are targeted in a proposed quantum resistant Bitcoin fork. Talked a little bit about this in a couple of shows ago, but Alex has a full write-up of it. So let's revisit this Bitcoin improvement proposal and see how, honestly, I think it's more fear-mongering than anything else, but you got to know what's going on out there, guys. Bitcoin could be about to get a major change. A new proposal suggests some coins might have to be destroyed to protect the entirety of the network from future quantum computer attacks. Let me pause already. When this sentence right here, Bitcoin could be about to get a major change, no, it's not going to get, not only is it probably this BIP never going to see the light of day, it certainly isn't going to happen quickly. It's not about to get anything. If anything, it'll be years before anything like this is even proposed, because this is an attack on the man in the coma. And you'll figure out why here in a little bit. And if you didn't know, man in the coma, here's the theory. I have Bitcoin. I get hit by a truck, right? All my Bitcoin's held by private keys, and I'm the only one that knows where I put those keys. I get hit by a truck. I get put in a coma for 40 years. I wake up, and I'm a trillionaire, and I still remember how to go access my private keys. However, one of two things could have happened. Even if I have my private keys, if the network has changed consensus rules to the greatest degree possible that my private keys do not work anymore, I'm fucking hosed. I cannot, even with my private keys, I cannot get my Bitcoin. And two, the only thing that could possibly happen to the network is a series of soft forks, which don't change consensus rules, in which case my private keys work just fine. And I'm happy because I'm a trillionaire, and my hospital bill is like 157 Satoshis or something like that. All right, so that's the man in the coma theory. Now, you're going to figure out why this particular thing is the first kind of attack, where the private keys would probably not work, or you just don't have your coins. Because the proposal is called QRAMP, short for Quantum Resistant Address Mitigation Protocol. It was put forward by Bitcoin developer Augustin Cruz and has caused quite the stir in the Bitcoin community. Bitcoin security is based on the ECDSA cryptographic system, elliptic curve digital signature algorithm, that's strong against regular computers but might be broken by quantum computers in time. Quantum computers use a new kind of processing procedure based on the laws of quantum physics. Instead of working with just ones and zeros like regular computers, they use qubits, which can exist in multiple states all at once. And that means they can do specific, complex calculations much faster. Cruz and other developers worry that one day a powerful quantum machine could crack Bitcoin security and allow hackers to steal coins from vulnerable wallets. Cruz said, quote, addresses that have exposed their public keys may now be vulnerable if sufficiently powerful quantum computers emerge. Cruz's QRAMP proposal is a major update, a hard fork, not a soft fork, but a hard fork to the Bitcoin network. A hard fork is a big software change that creates brand new rules for Bitcoin and essentially creates a brand new blockchain. Older versions of the software would no longer be compatible. If QRAMP were to be adopted, all Bitcoin users will get a deadline. Before that deadline, they would need to move their Bitcoin from old vulnerable addresses to quantum-resistant ones. If they don't do this in time, their coins will become unspendable. The idea is to force users to secure their funds before quantum computers become a real threat. It provides rightful owners with a clear, non-negotiable opportunity to secure their funds, Cruz wrote in an email. But there's a big catch. Any coins that remain in vulnerable wallets after the deadline would effectively be burned. This means the total supply of Bitcoin could shrink, possibly by millions of coins. The intense debate over this idea has really brought out the passion in Bitcoin supporters. Some see it as a smart way to safeguard the digital asset's future. They believe acting early before a quantum disaster strikes is better than waiting. It's better to burn off some of those Bitcoin now than risk losing them all, one supporter put it. Others think the plan goes too far. They say it undermines two of Bitcoin's core principles, decentralization and immutability. That means no one can change Bitcoin's history or rules. Many people are worried about the coins locked away in dormant wallets. Those belong to users who've lost their private keys, passed away, or simply haven't accessed their funds in years. Among those is Bitcoin creator Satoshi Nakamoto. Analysts estimate that Satoshi himself has over 1 million coins that hasn't been touched in over 15 years. If those people don't migrate their coins, they will be lost forever. However, history shows that not all dormant coins are forgotten or lost. There have been instances of old wallets activating after 10 years. Quote, I admire the effort, one Reddit user wrote, but this will still leave everyone who doesn't migrate coins vulnerable, including Satoshi's coins. QRAMP is just a draft proposal at this stage. It doesn't even have a BIP number, and the Bitcoin community hasn't reached consensus to move forward. Implementing QRAMP would require a lot of work from users. Wallet developers, miners, node operators, and infrastructure providers, and everyone in the ecosystem would have to agree and update their software to support the change. Microsoft's recent announcement of the Majorana 1 quantum chip, which could scale up 1 million qubits, might be why this discussion is happening now. Current machines don't pose an immediate threat, but the technology is advancing. Other ideas have been proposed to protect Bitcoin from quantum threats, and such an idea from BTQ is a new kind of blockchain verification method using coarse-grained boson sampling, but that would require replacing existing mining hardware with quantum-compatible systems. Okay, that's why it's an attack on the man in the coma. If you're in a coma and QRAMP gets initiated, and you're still in a coma by the deadline, your coins get burned, which means you didn't have access to the coins in the first place. This is a terrible idea. Everything about this is a terrible idea. In fact, that last statement that I said where you didn't really have possession of your own coins anyway, you didn't really have that much control that you thought, all that does is erode trust in the system, and it should. It absolutely should. This QRAMP thing is fucking ridiculous. Okay, so you'll be going, okay, well, what's your answer? A brand new blockchain. We've seen this before. Check this out. And I don't mean to replace, I don't really mean this to replace Bitcoin. I'm just conjecturing here. It's not outside the realm of possibility that the danger of a quantum situation or a quantum, what they call it, quantum catastrophe, that's not impossible. And ECDSA could very well be vulnerable, which means all of the wallet addresses that have ever been, if that gets cracked, that a lot of crap is going to be vulnerable. But it's not just Bitcoin. Quantum computers means cracking nuclear codes all bank security access, and for some reason people think they're going to go after Bitcoin first. I kind of doubt it. You got way bigger problems with quantum computer than just, or quantum computing rather than just Bitcoin having a problem, right? So here's, and I don't think this is a viable solution, but it's like it's a different way of thinking about this. Throughout the ages of Bitcoin, so we're talking 16 years, there have been multiple forks. And I'm going to point at one in particular, the Bitcoin Cash fork. It was the culmination of the war of block size, also known as the block size war, right? So what happened was that anybody that held Bitcoin in any address had the same exact amount of Bitcoin on the new fork, the Bitcoin Core, or the Bitcoin Cash fork. Now, what did I do with my coins? I traded them directly for Bitcoin. That's the first chance that I got control of my Bitcoin Cash, I immediately liquidated that shit directly into Bitcoin. I didn't even stop at cash. I just went straight into Bitcoin. All right? But I didn't have to. I did it because I didn't like what Roger Ver was doing, and I wanted to make sure that I was not responsible for having any value in that chain whatsoever. And I wasn't the only one. However, let's say we do this again. We fork this chain. There's a snapshot that's taken on a particular day, and everybody knows it's going to happen. A snapshot of who owns what, or what, rather not who, but what addresses have what Bitcoin. The new fork is all the quantum resistance that you would ever need, just dripping with quantum resistance, right? It's going to be fine. And then we don't sell those coins. We just don't. Let's say we just don't. It's just a backup, right? If a quantum attack actually happens, we have the choice to migrate to that chain, but we don't have to move the coins from the original chain anywhere. That's the problem that I'm seeing with this entire idea, this QRAMP idea. I don't think it's necessary. If we could just have almost like a mirror universe of what's going on the Bitcoin chain that is updated live on the other quantum resistant chain, I think that would actually work. But who's going to mine it? Who's going to run a node for it? So even that idea has its own problems because people would actually have to invest real world assets to be able to functionally run that chain. But I do not think forcing people to move their coins by a certain date is anywhere close to coming into line with Bitcoin's ethos. It's just not. All right, so we'll move on because FTX has extended once again the KYC deadline, and $2.5 billion in refunds are at risk. The failed exchange initially required users to complete verification by March 3rd of 2025. And recognizing the scale of this issue, the administrators have extended that deadline to June 1st, 2025. Ladies and gentlemen, if you are one of the nearly 400,000 former FTX customers, you have until June 1st to do your know your customer stuff, and they are going to force it. If they're going to give you your money back, you're going to be handing over your driver's license. So just be aware, June 1st is the new deadline. And then mempool version 3.2.0, stratum jobs, UTXO bubble charts, address poisoning detection, and more. So mempool is a fully featured open source mempool, visualizer, explorer, and API service. A live instance is running at mempool.space, mempool.space. I use it all the time. And it can also be self-hosted on a wide variety of your own hardware, which I also do. My Start 9 has its own instance of mempool, and that's what I use when I'm sending transactions. All right, so the new features in mempool include support for V3 transactions, anchor outputs, UTXO bubble chart, data miner tags, runestone tags, package broadcasts, stratum job visualizations, taproot multisig labels, transaction and PSBT previews, and address poisoning detection warnings. So the new UTXO bubble chart Users will find a new bubble chart on the address page, providing visual insights into unspent transaction outputs. Data miner tags and tags to identify runestone messages and inscriptions are there. The package broadcast feature is there for sending transaction packages. Stratum job data visualizations for a better understanding of mining job details. Jesus, I'm going to have to go back and look at this new mempool thing because I didn't see any of this when I was setting up the show. Taproot multi-sig labels to identify multi-signature transactions using Taproot. And this is the reason I'm bringing this to you. We talked yesterday about address poisoning. Well, mempool has already answered with address poisoning detection. Address poisoning detection helps identify and mitigate risks associated with address misuse. So go check out mempool.space. That's mempool.space. Version 3 is underway. And I'm assuming that means it's live right now. I haven't seen anything that said that it's not. So I'm going to go check that out. You should go check that out. And I will see you on the other side.
This has been Bitcoin and I'm your host, David Bennett. I hope you enjoyed today's episode and hope to see you again real soon. Have a great day.